No cash rate cuts until 2025. We're going to unpack what's going on in Australia's economy and what's going to happen to the cash rate in 2024 and 2025. There's even some talks out there that the cash rate might go from 4.35% to 5% in the next 6 to 12 months. And even some of Australia's biggest banks are forecasting no cuts until the end of 2024. Now, my name's Luke and I talk all things real estate, renovating and financial freedom here on the channel. If you've watched any of my videos before and you haven't subscribed yet, make sure you go down there and subscribe. We recently hit 15,000 subscribers, which is a massive milestone. And I love all your guys' comments and thoughts and feedback on the videos. Really enjoying growing this channel together. And I've loved sharing my own personal journey with you guys here on the YouTube channel and excited to continue doing that as we move forward into 2024 and 2025. But what on earth is going to happen with the cash rate? The RBA is a bit of a red herring at the moment. We don't know what they're going to do. They put out statements. They say they're going to do one thing, but the RBA is going to be a little bit more conservative this year as they've got a new chair and as they're doing less meetings in 2024. So the current RBA cash rate is 4.35% and our inflation target is 2 to 3% and has been since 2021. The RBA has lifted rates 13 times to reach 4.35% over roughly the last 18 months. And as you can see on screen here, this is the lift from April 2022 up to 4.35% in March 2024. Now, I think one of the most interesting recent predictions comes out of Judo Bank economic head Warren Hogan. Among the most accurate RBA forecasters of 2023, he believes that inflation has gotten out of hand and the RBA board will be forced to act and forced to increase rates. He predicts there could be as many as 3 cash rate hikes in 2024, potentially seeing it soar over 5% for the cash rate. What this would mean for the everyday Australian and the everyday mortgage holder is rates getting up around that 7 to 7.5% mark. We're currently sitting for the average mortgage holder around that 6.5% mark. But another 0.7 increase would take us to around 7 to 7.3% for the everyday Australian with one of Australia's big 4 banks. Now, if you're an SMSF lender or you're in a company and trust structure, or you've got a lot of borrowing, so you've got millions of dollars worth of debt, your interest rate might be going up towards 8, 9, 9.5% if you're with those second and third tier lenders. Another interesting point that Warren Hogan made is with inflation of 3.6% taken into account, the real cash rate is essentially 0.75%. And a real balanced economy sees a cash rate in the range of 2%, implying even more than 3 rate hikes might need to happen. So essentially what he's saying is because we've seen inflation over the last 12 months, and we've seen the cash rate rise, the actual inflation on Australia's economy, the disparity between the cash rate and inflation in the market is not enough. We want to see 2%, but we're only sitting around at 0.75% with the current position. So essentially hiking up the cash rate further would put more downward pressure on the economy and keep things deflated. That's obviously not happening in the property market. Even though rates have increased significantly, property is still driving in terms of prices. And I've made another recent video about why that's the case, if you want to click that card somewhere over there. So the long story short is the cash rate needs to go up for inflation to come down. Now, there's some other interesting data coming out of our big 4 banks, CBA, Westpac, NAB, and ANZ. The big banks' predictions for May's RBA meeting is that the RBA will hold the cash rate at 4.35%, and all the banks are in agreement that that's likely to happen. Their forecasted next move by the RBA is a 0.25% cut, which will take us down to 4.1% cash rate in November 2024. And then some of the banks are expecting a different level of cuts in 2025. CBA, Westpac, and NAB are expecting 4 cuts sometime in 2025, whereas ANZ's only expecting 2 cuts in 2025. To be perfectly honest, what we're seeing on the ground is different markets struggling in Australia's economy. Property prices are going up, as well as food, beverages, costs of supply, fuel. The everyday things Australians need and use are going up significantly higher than the RBA's target band of a 2% inflation. Another really critical factor is the net overseas migration, which has put upward pressure on the consumer price index basket, and housing is a big component of that. This has made the RBA's task of returning inflation to target more difficult. Now, this is why I think rate cuts in 2024 are looking less and less likely. I don't even know if we're going to see a rate cut this year or even early next year. And we might be seeing people who have mortgages receive more and more pain. But is it even going to dampen property prices? Because with that overseas migration, with the demand and supply equation that we've got here in Australia when it comes to property, I don't even know if a 5% cash rate and an effective rate of 7% interest rates are even going to dampen the property market. It might dampen some of the other areas of Australia's economy if the cash rate goes up. But the other thing to think about is that not everyone is a mortgage holder. This blunt instrument that the RBA uses affects mortgage holders and people who have debt in Australia's economy. But a good 30% are debt-free. 30% are renters who feel the pain indirectly because of the increase in rental property prices. And the other 30% are the mortgage holders who are going to feel the increase if the RBA does increase rates or even keep them on hold for a long period of time. What we're seeing boots on the ground in our buyers agency here at Purpose Property between myself and the team is competition. I don't see people out here looking scared at Australia's property market or fearful of what the RBA might do over the next 6 to 12 months. Yes, people are keeping an eye on the cash rate. Maybe it'll increase a little bit. Maybe they'll do a cut next year. But really, I think a lot of investors are running their interest rates at 7.5% or maybe even 8, 9% if they're using correct buffers and having confidence to act over a long term. Property is a long-term game. You shouldn't be looking at the market over the next 12 months and going, 7% interest rate, I don't know if I can handle that. If you can't handle a 7, 8, 9% interest rate, you probably shouldn't be investing in property. You need to have your own buffers in place to make sure you're confident with your investing decisions. Emily and I like to run our numbers off a 3 to 4% buffer. So in my scenario, I like to run all of our debt off around a 9 to 10% interest rate. What's the worst case scenario? How long can we hold on at that interest rate? Are we comfortable with those numbers? If the answer is yes, then I'm right to continue investing. If investing puts you in a dire situation when you can't manage a 7, 8, 9, 10% interest rate, then maybe you need to look at the different type of asset you're buying. Maybe you need to buy with some more cash flow. Or if you are going to focus on growth, maybe you need to increase your day job income to ensure you can service that debt. It's important to have these plans in place. People ask me all the time, Luke, don't you have a concrete plan of what you want to do in the future in terms of the investments you're purchasing and the exact asset? I always say I have a guide. I have a rough guide of the big goals I want to hit. I talk about the motel that I want to buy on the YouTube channel. I put it out there into the YouTube universe and say, hey, this is something we're thinking about doing. This is the ballpark price. We want to spend $2.5 to $3.5 million on this asset. This is how I'm going to finance it. I'm going to use this home. I'm going to pull out some investment debt at around $1 million, and then I'm going to use that as my deposit to buy a $2 to $3 million asset and then renovate and add value. And that's the bigger picture. Maybe I end up buying a standard unit block and I don't buy a motel. Maybe the plans change or I buy a house in a granny flat and I go for more cash flow strategies. I think the big thing is to have the big targets that you're wanting to achieve and then keeping an eye on the market, looking at the interest rates, looking at how you can increase your day job income, looking at how you can add value to your current property portfolio and continue moving forward. A lot of people get stuck in the mud. Oh, it's too difficult. There's too many decisions to make. Get yourself up, get your head out of the trees, or whatever the phrases are. Get your head up and see where you're heading. Make sure you understand the numbers along the way and plan for that future. If you want to sit down and have a chat with myself about your strategy and you're looking to buy a property here in Southeast Queensland in the next 3 to 6 months, then head over to purposeproperty.com.au to book in a free strategy session with myself. We're going to sit down and talk about what's going on in the market, talk about your current position and your current numbers, and how we can help you buy a property here in the Brisbane market. I'd love to hear your thoughts in the comments below. Where do you think the cash rate is heading? Now the RBA is not meeting as frequently. The big banks are predicting some cuts late this year, but I don't think they're going to happen. And some economists are predicting an RBA cash rate increase given what's happening with inflation in Australia's market. So what do you think's happening? Drop a like on this video, subscribe to the channel, and click this video over here because YouTube thinks you'll really like it. Thanks for sticking around. I'll see you in the next one. Peace.